Good morning. If you were feeling bullish after Thursday's big market rally, you're going to want to pay very close attention. Because while the markets were closed for the long weekend, the entire game completely changed.
You know, we're stepping into what's called a structural regime change. And that's really just a technical way of saying that the fundamental rules that were driving the market, they've suddenly shifted. So whatever you were thinking about that late rally on Thursday, forget it. The entire game board has been reset.
So, what does that mean for how we see Thursday's close? Well, it means that rally wasn't a sign of strength at all. It was actually the setup for a trap. And today, we're going to break down exactly how that trap is about to get sprung. Let's start with what went down over the weekend. Right. So over the weekend, the big picture economic view just caught fire. We got hit with two massive, completely unexpected shocks that have totally altered the landscape. And now the market has to scramble to reprice for this brand new reality. First up was the Good Friday jobs report. And you can see it right here. The difference between what everyone expected and what actually happened was just staggering. The market was looking for about 51,000 jobs, but the actual number, it came in at 178,000. It didn't just bait the consensus, it absolutely obliterated it. And, as if a red-hot labor market wasn't enough to digest, we also saw crude oil just surge past $106 a barrel. This was all thanks to escalating geopolitical tensions. This was shock number two. So you put these two things together, right? A hot jobs market and soaring energy prices. What do you get? A textbook stagflationary shock. And that is a toxic mix of slowing growth and high inflation. And in an environment like this, any little hope that was left for the Fed to cut interest rates is just gone. It is completely off the table. Okay, so what does this all mean for the market open? Well, the futures market is pricing the S&P 500 to open way, way down, right around 65.71. Now, the crucial thing to understand here is that this isn't just a small drop. We are opening significantly lower, right in the middle of what traders call negative gamma territory. And that is a very unstable zone where small moves can get amplified into massive ones fast. Now, let's tie this back to the market itself. That big gap down at the open is about to collide head-on with some very specific positioning from the big institutions. While a lot of people saw Thursday's close as bullish, the real story, the one that's hidden in the trading data, paints a very, very different picture. See, the big institutions weren't making a simple bullish bet. They were doing something way more sophisticated. It's called a straddle. And essentially, they weren't betting on which way the market would go. They were betting on a huge explosion in volatility in either direction. And this just shows it perfectly. If you look at the trading data from late Thursday, it's plain as day. At 3:35 p.m., boom, a massive 600-lot straddle. Just 5 minutes later, another huge 500-lot one. And both of them were executed perfectly at the 6,600 price level. This was the trap being set, right there in plain sight. So what's the consequence of this? Well, for the market makers who had to take the other side of that huge trade, it puts them in an incredibly dangerous and exposed position. It's known as double short gamma. And what it means is they are now betting against a big move in either direction right at that 6,600 level. And that makes them extremely vulnerable to the weekend's news. So this brings us to the actual physics of what's about to happen at the opening bell. That double short gamma position, it's like a coiled spring. And this morning's huge gap down is exactly the thing that's going to release all that tension, triggering a pre-programmed algorithmic selling cascade. And what's fueling this fire? It's the explosion in short-term volatility. The VIX one-day, which basically measures the expected move for today only, has spiked to nearly 28%. A reading this high signals extreme fear, and it puts us in a situation where the actions of those market makers will actually accelerate the market's move, not slow it down. So with this level of volatility, the math tells us to expect a massive move of plus or minus 114 points today. And that gives us our operating boundaries for the session, an upside around 66.86 and a potential trapdoor floor all the way down at 64.57. So let's just walk through this chain reaction. First, the market gaps down. When that happens, the risk on the dealer's short positions absolutely surges. To protect themselves, to hedge their books, they are forced to sell, which of course pushes the market even lower. And this isn't a person making a decision. Their algorithms are programmed to do this automatically and at lightning speed. And this whole cascade gets supercharged by a few other technical factors. The spike in fear forces even more selling.
The long weekend made protective options lose value, so traders are more exposed. And finally, because we're opening below a key technical level, the algorithms are just designed to hit the sell button even harder. It really is a perfect storm for a downward spiral.
Okay, so that's the setup. The trap has been set, and it's about to be sprung. The critical question now is, how do we navigate this? So here is the execution playbook for today's session.
The single most important rule today is simple, and you absolutely must not break it. Do not try to front-run the dealer's forced selling. The first 45 minutes of this market belong entirely to the algorithms. Do not try to be a hero and buy this opening drop. Now, we are watching two main scenarios unfold. Scenario 1, which we think has about a 60% probability, is what we call the flush and fade. We let the algorithms flush the market down towards that 6,500 level. If selling shows signs of drying up there, a sharp recovery is possible. Scenario 2, with a 40% probability, is the cascade. This is if that 6,500 level breaks. Then the selling can accelerate as dealers just give up, and the next target becomes that floor down at 6,457. So what is the most important takeaway from all of this? It's that patience is your greatest asset today. In a market where the structure is this clear and the trap has been so perfectly set, your job isn't to outsmart the market. It's to step aside, let the initial algorithmic selling play out, and then act. That is how you navigate today's session.